Today we'll be discussing Module 8, Global Banking Laws and Regulatory Frameworks. Global banking operates within a complex system of laws and regulations designed to ensure financial stability, protect investors, and maintain the integrity of financial markets. Investment banks operate across multiple jurisdictions, making regulatory compliance a critical component of their operations. By way of module objectives, students should be able to, at the end of this module, explain the purpose and importance of banking laws in global financial systems, identify key regulatory frameworks across major jurisdictions, understand the role of regulatory authorities and supervisory institutions, analyze differences in banking regulations between countries, explain the concept of cross-border financial regulation, understand international banking standards such as capital adequacy requirements, evaluate the role of central banks in maintaining financial stability, assess the importance of security regulators in protecting investors, and lastly, analyze the challenges of regulatory coordination in global finance. By way of introduction, the global banking system is governed by legal frameworks that ensure institutions operate safely, transparently, and responsibly. These laws define how financial institutions are structured and how they interact with the markets. Investment banking is highly global, involving cross-border transactions such as mergers, capital raising, and foreign investment. This exposes banks to multiple regulatory systems that must be carefully navigated. Regulatory frameworks are essential for reducing systemic risk and preventing financial crises, especially after past global financial failures highlighted weaknesses in oversight systems. Let's look at banking laws across jurisdictions. Banking laws differ across countries but share common goals such as stability, investors' protection, and market integrity. These laws define permissible activities, capital requirements, and governance structure. Let's start with the first country, United States. The United States has a complex regulatory system with multiple agencies and laws such as the Dodd-Frank, which strengthen capital requirements, risk control, and oversight after the financial crisis. For the UK operates under a strong framework with laws like FSMA, focusing on prudential regulations, market conduct, and investor protection, especially due to London's global financial importance. The EU combines national and regional regulations through framework like the CRD and CRR. These are frameworks supported by the banking union to ensure consistency and stability across member states. For Canada and Australia, these countries emphasize prudential regulations, centralized oversight, and strong risk assessment, making them among the most stable financial systems globally. For China and India, emerging markets like China and India have evolving regulatory systems, balancing growth with control and requiring careful navigation by global investment banks. Now, for the UAE, United Arab Emirates, they provide a flexible regulatory environment with financial free zones, such as the DIFC, attracting global investment while maintaining international standards. For Africa, we're looking at Nigeria, South Africa, Kenya, and Ghana. African markets are developing, with South Africa being highly advanced in all of the African markets. Nigeria and others are strengthening frameworks to support growth and financial inclusions. Let's look at some more regulatory authorities. Regulatory authorities enforce financial laws, protect investors, and ensure stability. They monitor institutions and ensure compliance with established rules. Let's look at the difference between regulation and supervision. Regulation involves rulemaking, while supervision ensures compliance. So regulation, you are making the rule. Supervision, you are following up through compliance. Under compliance, you do it through monitoring, inspections, and enforcement actions. Let's look at US regulatory bodies properly. They include Federal Reserve, Security Exchange Commission, OCC, and FDIC. Each plays a role in financial in oversight, stability, and investor protection within the financial system. For the UK, the PROA focuses on financial stability, while the FCA ensures fair conduct and transparency in markets. For the EU, the ECB supervises bank, while the ESMA regulates financial securities. National regulators also play roles, creating a layered systems. Let's look at emerging market regulators. In Nigeria, Nigeria is an emerging market. The Central Bank of Nigeria and the SEC oversee banking and capital markets. Similar systems also emerge in other economies with increasing regulatory environment. Now let's look at role in investment banking. Regulators oversee IPOs, trading, mergers, and reporting, like we said, ensuring that banks operate within defined rules and maintain transparency. What are some of the regulatory challenges? We have difference in laws, reporting requirements, and legal systems. This creates complexity in cross-border transactions. We have the cross-border regulation. This regulation ensures stability and consistency across countries, reducing systemic risk in a globalized financial system. Now, this now led to the need for global standard. What pushed it? The 2008 crisis, the stock market financial crisis, showed the risk of fragmented systems leading to stronger international coordination and standards. Now let's look at the Basel framework. This is a framework that sets global standards for capital adequacy, risk management, and supervision, ensuring banks remain resilient. Let's look at the term capital adequacy. Capital adequacy ensures banks can absorb losses. It is measured using ratio comparing capital to risk-weighted assets. Now let's look at how the Basel framework evolved. Basel 1, that was the first, it introduced the basic rules. Basel 2 added complexity, while Basel 3 strengthened capital and liquidity requirements after the 2008 crisis. Now let's look at the liquidity requirements under Basel. It was Basel 3 that introduced the liquidity requirements, introducing the LCRO and NSFRO to ensure short-term and long-term financial stability. We have regulatory arbitrage. This occurs when institutions exploit differences in regulatory or in regulations across countries, undermining global standards. We look at coordination. Regulators collaborate intentionally to align standards, share information, and supervise global institutions. What are some of the challenges? Challenges include regulatory divergence, political issues, and enforcement difficulties across various jurisdictions. We look at financial market stability. A stable financial system supports economic growth, ensures liquidity, and maintains investors' confidence. What are the roles of central banks in an economy? Central banks manage the monetary policy, the liquidity, and financial stability, influencing investment banking activities. Under monetary policy, interest rates affect capital costs, asset valuation, and investment decisions. So this is how the central bank affects investment banking. The central bank is also a lender of last resort. They provide emergency funding to prevent bank failures and systemic crises. They also carry out bank supervision. They monitor risk, enforce compliance, and ensure resilience of financial institutions. They also carry out um, currency stability. There is exchange rate management, support international transaction and reduce uncertainty. Let's look at securities regulators. What do they do? They oversee capital market, ensuring fairness, transparency, and investor protection. Let's start with the first, investor protection. They ensure disclosure, transparency, and accurate information for investors. For market integrity, they prevent insider trading and manipulation, ensuring that there is fair participation. They also carry out security issuance. They oversee initial public offerings and bond issuance, ensuring compliance and fairness. They carry out enforcement also. They impose penalties and ensure compliance, maintaining discipline in markets. How do these institutions interact, the CBN and the regulators? The central banks ensure system stability, while regulators ensure market fairness, working together to maintain the financial system. For crisis management, during crisis management, central bank provide liquidity, while regulators impose controls to stabilize markets. From a global perspective, different countries have different structure, but all aim for stability, investor protection, and market efficiency. By way of conclusion, this module has provided a comprehensive and critical examination of global banking laws and regulatory frameworks, emphasizing their central role in shaping the behavior, structure, and stability of financial systems around the world. It has demonstrated that investment banking does not operate in isolation, but within a highly regulated environment where legal compliance, institutional oversight, and international coordinations are essential. At the end of this module, there's an assessment session with a quiz and a regulatory analysis report to test your understanding of this module. I'll see you on the next module.